John Cole Scott, one MLP you like over at Closed End Fund Advisors is the NUVEEN Energy MLP Total Return Fund. The ticker is JMF. Why do you like the pipelines now?
I like them because they're beat up, and yet their midstream toll revenue is independent of the price of oil for the most part. And when we think about all closed-end funds, we blend discount analysis, manager results, and dividend coverage. This one's at a 9 discount, 7 and change yield. The dividend is almost all return of capital historically, and it's beating its peer group by 4% on a one-year basis on a manager level. And again, it's a great way to access the sector with the upside of people agreeing with you later.
Next on my list is from BlackRock. It's the BTA, and it's the BlackRock Long-Term Municipal Bond Fund. It's got a nice 6% yield. Tell me about it.
It is. So it's also at a 9 discount when the sector is about a 7 discount. What we like about it, it's a little less liquid, but it's got 99% earnings coverage, which is above normal. It's beaten its peer group by about 0.5% of performance a year, and yet its dividend is a little bit above average, and it's only 7% non-investment grade and only a third levered, which is moderate to low for closed-end funds.
All right, the next one on my list is the ETY. It comes from Eaton Vance. It's their tax-managed diversified equity income fund. What's special here?
Well, so covered call funds have about a third less volatility than the U.S. stock market, so it's helpful when you think markets might get volatile, yet you can't be in bonds. This fund, again, it's about a 9 discount or so, about an 8.5 yield. It's beating its peer group on a NAV basis, and most of its yield is that return of capital that is good for tax reasons. So again, great way to get income, less volatility than the U.S. markets, and not be worried about bond duration.
And then finally, you're a fan of Medley Capital. This is a BDC, a business development company. Yields around 16%. It's not easy to find yield in this market. This one has it. Tell me about it.
Well, actually, the yield's closer to 13.5 based on the current indicated value and the pricing. But BDCs generally have a little more leverage, 45%. Their investments are private loans. This one is about 90 and change percent loans. The loans are 2/3 first lien and almost 3/4 variable, which means if you're going to be in that space, you want to be the first lien like a first mortgage. You want to be set for rising rates. And you have the discount being like 25%. And the leverage being 45%, the manager only has to blend 6.9 to fuel the 13.5. So and they've never issued stock below net asset value, which is often something BDCs do that annoys shareholders. So they've had a few issues, a lot of BDCs have, but it's a great way to get a dividend that's covered in a portfolio that's quality.
All right, thanks a lot, John Cole Scott.
Sure. Good to see you.
And thank you for watching The Street.